Hi, good morning, everyone. Thank you very much, Daniel and Pallav and the entire PMS Bazaar team for organizing this year on year and giving us the opportunity, for all of us to come together, meet each other, network, and also share ideas. Today, what I'm going to speak on is a highly debated topic, and I think that, let me tell you one thing. In this room, maybe there are over 100 people right now, and there are many on YouTube and on social media. For the moment, if I just ask you that in investment management, in portfolio advisory, wealth management, whatever field that you practice, how many of you think that you are above average in your field? Please raise your hand. How many of you think you're above average? So, I don't need to make this presentation. As long as 90% of the people think that they are above average, the chase for alpha will always be there, correct? Because index is about buying averages, and here in this room, 90% people think they're above average. So there's no question not chasing alpha. But anyway, that is more like a, anecdotal, small sample size survey. But I think to earn our bread, we definitely need to talk with data. So the presentation that I'm covering is broken up into 4 parts. One is I'm going to talk about the US experience. The reason is because there are a lot of myths to be debunked. Every time there is a discussion on active versus passive, before first me few disclaimers. I have played or I have worked very hard to launch passive products in a previous life, so I have no biases. Second point is that there is space for both. And third point is that if active managers don't outperform the benchmark, then from an investor's perspective or an advisor's perspective, it's a no-brainer. People will buy the index, correct? So there's nothing really to debate. The only thing that is left to discuss is whether there is potential for active management in India or not. And a lot of our learning and a lot of experience is always cited from the US. So the first part of the presentation is going to be more about debunking some myths, sharing some data on US, and at least to clarify that why you should never form your perceptions about active management based on any information from the US, right? So first and most important, financial services industry is known to be great at marketing. They are known to make simple things very complex. So the most common thing you hear from the Western world is that money is moving from active mutual funds into passive mutual funds. Let me tell you, that is half the story. That is a marketing story. The reality is that as much money is moving from active to passive, more than that is actually moving from active products into alternates. So let me put it this way, that let us say it's my job to sell Coca-Cola, right? So what I do is, to all the ordinary people, I say Coca-Cola is not good for you, you must have only soda. And then to the rich people, I go and say that you should only buy concentrate, why are you buying Coca-Cola? Correct? That's the difference. So the reality is that more than the money going from active to passive, at least in the US, the bigger trend has been that money has moved from active to alternates. So what is happening is that ordinary retail investors are being told there is no alpha, you should only buy passive. And rich people and institutions are being told that there is abundance of alpha, why don't you buy alternates, right? So the point is, it's not that in the US, it's not that there is no alpha. I will show you with data that the alpha has only migrated to the private market. That's the simple point to keep in mind. So what is the first trend? The first trend, obviously, in the US is that a lot of the investment management industry has got institutionalized. This is well known, nothing to talk about. But the more important trend is that institutions have alternatized their portfolios. So while bulk of the industry has got institutionalized, institutions have put more than 60% of their money into alternates. So in the US, the first private equity fund came 40 years back. In India, it's barely 10 to 15 years back, or maybe less than 2 decades. In US, the buyout funds industry has gone from practically 0 to 2 trillion in the last 15 to 20 years, right? So high institutionalization and institutions putting money into alternates. You can understand where the alpha is actually going. 2-3 important data points which you will be zapped to know. In the US, by the way, the number of micro-cap, small-cap companies is actually reducing. And the other shocker data is that in last 25 years in the US, market cap has gone up 3x, but the number of listed companies has become half. So what does it show? There are 3,643 listed companies as of end of 2019. I'm sure you know how many there are in India, right? In the US, when people want to create alpha, they are chasing Mr. Musk. In India, footwear companies are getting listed and you're buying them for 2,000 crore market cap. So these are few important things to understand, and this is where I mentioned, you can clearly see buyout funds have nearly become 2 trillion. So what is happening is that a lot of the play field for the active managers is consistently shrinking. And a lot of that alpha is going from public equities into the private markets. I'm sure you will agree with me that all these trends, well, they might come to India in the next 2 decades or so, but clearly we are not there yet. That is one thing to keep in mind. The other important information is, look at it this way. If Uber gets listed at $75 billion market cap, where does the alpha go, right? So the public guys obviously didn't make money, but who made money? So what this chart actually tells you is that on an average, companies in the US come for listing 15 years, 12 to 15 years after they have spent time in the arms of a private equity fund. In India, companies come for listing at 1,000 crore market cap. Sometimes no private equity straight to the market. So you can imagine where the alpha is actually going in each of these cases. So this is the first part. Second is there, so having seen this, is there scope for alpha as far as Indian markets are concerned? Now there are a few things I'm going to move very quickly. Basically, if you see market cap and evolution of GDP, India is where China was in 2007, and India is where US was in the early 90s. This is something which is very well known, discussed to death. You know that we are likely to be the 3rd largest economy in the world, but this is not what really wins our bread. Where our bread and butter comes from is basically this. All these per capita incomes, for a fact that right now we are about $2,400 per capita income, and this per capita income business is just like playing that video game when we were youngsters. When you play a video game, as you cross different levels, more and more tools and weapons open up. You become a more empowered player. Obviously, the game becomes faster and more challenging, but you also become a more empowered player. Same way, in any country's destiny, when per capita incomes rise, that is when more and more sectors actually open up. So what you will find is that vast parts of India's market, like I gave an example, a few years back, when I started my career, the company I worked for, they launched something called an FMCG fund. And that fund basically had 5 stocks. Today, the youngsters today, you might realize, we don't call it FMCG anymore, we call it consumer. And then consumer is consumer discretionary and consumer staples. And then previously what was penetration, everybody asked companies for premiumization. So the world has changed dramatically. And that is what happens when per capita incomes change. Because per capita incomes, like I said, is like, levels of per capita income are like opening levels of a video game. You become a more empowered player. The market becomes more powerful, more, higher velocity. And at the same time, it becomes faster. If you see India as a market for alpha potential, by the way, there are a few things you should notice here very, very quickly. The largest listed sector in China is consumer discretionary. Okay, just giving you some food for thought. But basically what this chart shows you is, in India, very normally you say create a diversified equity fund. Can you do that in a Taiwan or a South Korea? Answer is no. Because in most of these markets, it is 1 or 2 sectors which dominate the entire market cap. Whereas India is the only country, it's the most diversified emerging market in the whole world, right? It's the only country where you have every sector listed, and I have not put that data here to save time, but we have every sector listed, and if you dig deeper, you will find that in every sector, we have small cap, mid cap, and large cap companies. So it's the most diverse market and a happy hunting ground for people who are actually seeking alpha. The previous data was for the whole market. This is for small and mid cap. You can clearly see that even in small and mid cap, India is actually the least concentration. Basically, what you see below HHI is Herfindahl-Hirschman index. It's an index of sector concentration. And it shows India is the most diverse. The other important thing is that the world's largest listed company is 66% of India's total market cap. And India's largest listed company is less than 1/10 of the world's largest market cap. And in the top 100 companies in the world, we only have 3, right? So this is the level where we are. This is just a comparison of where India is versus China and US. So you can see clearly, India's biggest retailing company is $33 billion market cap. In China, it is 202 billion. In US, it's over $1 trillion. And then we've given examples for every sector, right? So moving quickly, this is basically Wall Street Journal article, which tracked funds across, so basically they said 2008 to 2013, who generated highest alpha, and then were those same guys able to generate alpha in 2009 to 2014. Last few years' story is different, but basically it has been well researched that the alpha potential in India is extremely, extremely high. So what I'll do is, just for just to save time, I'll just leave it for you to keep in mind that do not worry about indices capturing the market before the market captures the economy, right? Because large parts of the Indian economy are not yet even introduced into the markets. Third thing, so, we've said that don't draw upon US experience. We've said that there is a lot of potential in the Indian markets, but then obviously recent experience is not that great because, many managers, if you see mutual funds, and in some cases even in PMSs and AIFs, in recent times, many managers have not actually beaten the benchmark. So despite all of this background, what is the reason? Why is it that managers haven't outperformed? Now very quickly, there are 3 or 4 things to keep in mind. First and foremost, before I shoot all the data at you, one thing you should keep in mind, I'll just tell you something which is easier to understand. If you take first of all, when people say there is no alpha, what is the data that is presented to you? Last 1 year, last 3 year, last 5 year, last 10 year. CAGRs work like this because if you have 3 bad years, it will destroy the whole past decade, by the way. Let's understand this very, very clearly. That is how CAGR works because each and every year feeds into the entire data. Now, if I just tell you something, 2018 and 2019, these 2 years put together, you just look at Nifty 100, Nifty mid cap, Nifty small cap. 2018, 2019 put together, now listen to this carefully, 80% of all small cap stocks gave negative return. 60% of all mid cap stocks gave negative return. By the way, I have not reached COVID, I am talking before COVID. So 2018 and 2019, 80% of all small cap stocks gave negative return. 60% of all mid cap stocks gave negative return. Half of Nifty 100 gave negative return, but Nifty was positive. What does that actually tell you? Basic point is that when economic performance becomes extremely sluggish, 2018-19, this is the period when ILFS defaulted. After that, few banks and NBFCs went under. Our GDP growth was 3.7%. 2019-20 was negative, and 2021-22 has just about seen a kind of reversion to pre-COVID times. But basically, you have had a whole decade of disastrous economic performance. 2010 to 2020, Nifty EPS growth was barely 3 to 4%. In dollar terms, it was net negative, right? So if you have a series of disastrous economic performance period, basically what will happen is that when economic performance becomes very narrow, the market breadth becomes extremely narrow. And index performance also becomes very narrow. So if you have 3 bad years, as far as economic performance is concerned, you can rest assured that active managers will struggle. Because what are active managers actually trying to do? That's something which is food for thought. And now just to look at data, so we are almost at historic high in terms of top 2 stock concentration, historic high in terms of sector concentration of the benchmark, historic high in terms of largest 3 sectors weightage in the benchmark, right? So active managers are not just going to follow what the benchmark does. Obviously, they are going to try and identify businesses which grow their profits and cash flows faster than, or at least above the averages. So when index performance gets very, very narrow, see this is the data I was quoting from, 23rd Jan 2018 to December 2019. So from peak to trough, by the way, this is before the COVID trough, okay? In COVID, it actually got worse. Because you know that when COVID hit us, Jan 2018 small cap index was 12,000. When COVID hit us, it was 3,000. And that applies to the entire breadth of the market. This is what I was quoting from. So in this period, you can see what happened to the index performance. By the way, index was net positive in 2018-19 in terms of the appreciation. but the breadth of the market. And this is not a new phenomenon. By the way, if you go as far back as 2001, 2002, you would have found that active funds were struggling to beat the benchmark because economic performance was actually quite a disaster. So this actually, by the way, I've already spoken about this data, and this clearly corroborates what I said, that on an average, how much alpha is generated significantly depends on what type of breadth the market has. And I can tell you one thing, that last 10 years is not the best indicator of what type of economic breadth or what type of GDP growth or what type of market performance we've actually had. So look at it in times when there is broader market growth, when there is broader corporate earnings performance, when the GDP is normalized, like, more like 7% growth, which is a recent long term, right? And don't look at periods of 3 years, 3%, 4% and negative growth. So what happens is that, like I mentioned, if you have 3 bad years, the entire CAGR looks bad. By the way, I've done this data crunching myself. I welcome you to do it for yourself, and maybe I can share data with you. Instead of looking at last 1 year, 3 year, 5 years, if you look at discrete periods, look at 2011, 12, 13, 14, 15, you will find a different data point. You will find that more number of managers have been beating the benchmark if you look at discrete periods. But after 3 bad years, if you say 31st October 2022, let me look at last 3 years, last 5 years, you will get a different. So it's like this, data is like this. If you start and I want to prove something and you look for that data, you will get it. That's how, it's mentioned, right? If you torture data for long enough, it will confess to anything. So it depends what you are looking for when you are actually studying the data. And very important, decisions are not made on quantitatives. You have to draw qualitative inferences from the quantitatives for you to be able to make the right decisions, right? And the last thing, it's not like everything is just got to do with the economy and the market. I think one thing I can tell you is that in the last 10 years, what has happened is that AUMs have scaled dramatically. If I take equity mutual fund industry, it is up 10x. If I take PMS industry, I know for a fact, 2012 it was less than 10,000 crores, today it is kissing 3 lakh crores. AIFs didn't exist. Today, just our Cat 3 equity is more than 1.5 lakh crores. So the point is also that for managers, there is food for thought, which is that when your strategies have scaled up 10x, how are you building your active positions? In my experience, what I've seen is that a lot of active managers, their active positions are built knowingly, unknowingly, purely on factor weights. So somebody is a value manager, somebody is a low volatility manager, somebody is a quality manager, somebody is a small cap specialist, which basically means that a lot of your outperformance is inconsistent and patchy. Because when that factor is at play in the market, you're blowing the lights out. But eventually, when macros change, factors will go in and out of favor. So it's not like managers have done absolutely everything right. I think key thing to keep in mind is this, that when there is a high active weight which is achieved through factor bets, it is going to be inconsistent. But when you have a high active share with factors diversified, which means that you are neutralizing the effect of factors, so you are less exposed to macro vagaries, and your entire active share is coming from stock picking, I think that is likely to be more sustainable as compared to what you do with, so people don't say, I'll give you a simple example. From 2015 to 2018, domestic cyclicals did extremely well, and all growth-oriented strategies did very, very well. In the end of 2018, oil went to $88. So you say, oh, performance is bad because oil has gone down. So, well, yes, when oil was down, it helped you. Did you say that? No, you said it's your stock picking, correct? So when you have high active share, because of factor bets, it works very well when it works. When it doesn't work, it just doesn't work. So if you have strategies where the portfolio construction is balanced, but the active weight is generated only from stock picking, I think that is something which is likely to be a lot more sustainable. This is what it means. When you take top-down factor bets, sectors, they go in and out of favor. Factors and styles, they go in and out of favor. So what is most important is to have a balanced portfolio construction. Basically, you have a broad portfolio, you do bottom-up stock picking, and ensure that factors don't overpower your performance in either direction. So this is just to sum up. 2018-19 were disasters. So I think I've already said this, not to repeat. But one thing is true, there will always be good managers and not so good managers. I think that is part of life. One can't explain all of that. And I'll end with what I started. As long as 90% of the people believe they are above average, the chase for alpha will remain. But if you ask me, my view, I think last 5 years was different. Next 10 years, I think active managers will outperform. WhiteOak will be one of them, and you have the whole day, so you identify the rest. Wish you all the best. Thank you very much.